A good way to purchase investment properties and scale a real estate portfolio is through a debt service coverage ratio loan, better known as a DSCR loan. With a DSCR loan, the banks do not require any income documents at all. No tax returns, no W-2s, no pay stubs. The way the bank qualifies these loans are simple. They take the projected rental on the property, assuming a long-term tenant is going to be living in the property, and compare it against the mortgage payment you will have. Projected rental is calculated through a document called the 1007, which is a fancy way of saying comparative rent schedule, which is the compilation of all rentals in that area. After we receive the projected rent on the property, we can compare the two numbers and express it as a ratio. For example, we have a mortgage payment of $1,000 a month. We then have a projected rental at $1,200 a month. This results in a 1.2 debt service coverage ratio. Please take note to the ratio 1.2. This is the industry standard to qualify for these loans. In some cases, banks will be more lenient on these ratios for experienced investors, so you will see it closer to a 1 ratio or even under 1. The reason why banks will entertain lower debt service ratios is because these investors are using the property as an alternative investment like an Airbnb, which can produce a lot more than a long-term tenant would. The banks still underwrite these loans as if somebody was renting there long-term because, God forbid, the Airbnb market falls or the house doesn't pay as the investor thought they would. They have a safe way to recoup as much money as possible with a long-term tenant. If you're going into real estate investing, please reach out to me. I'd be happy to help any way I can.